Hello Propenomix people, and welcome to the supplement from the 17th of December 2023. As you know, I like to start with a quote, and this week's is, "An investment in knowledge pays the best interest." That's for Benjamin Franklin, polymath and founding father of the United States. So before we begin in earnest, if you haven't seen the Propenomix Advent Calendar because you listen on a podcast platform, it's worth checking out the Propenomix YouTube for the daily posts I'm doing throughout December to celebrate getting to 500 subscribers. Thanks to all the regular readers and listeners who have subscribed. If you haven't yet, what are you waiting for? Please can you recommend me to a friend who you think would be interested? I'm loving the commentary, feedback and interaction that I get on there. So, welcome to the supplement. 8 more sleeps, or 1 more supplement if you prefer, until Christmas. Yes, there'll be a supplement on Christmas Eve, don't panic. And New Year's Eve. As I said earlier this year, unless there's been a nuclear event near South Birmingham, there's a supplement on a Sunday morning. I've enjoyed the Advent Calendar series so much, as an aside, that I'm open to any suggestions for the new year. I've got a couple of ideas, but would rather just take any feedback for the new video content from anyone who has any. Quite the macro fortnight leading up to Christmas, but in between Christmas and New Year is devoid of much of interest, other than the nationwide's annual and monthly figures. So there's an opportunity for a reflective piece, which I'm always keen to write anyway. This week saw employment figures released. Most just concentrate on unemployment, but I do like to look at the bigger picture. Vacancies were down again for the 17th time in a row, but only to 949,000 on the quarter, which is still the highest print ever if we go back before the pandemic. The trend is still contraction, but there's still a lot of jobs out there. Pay growth moved down to 7.3% from 8%, which was a much sharper fall than expected. This sort of movement downwards will start to make Jeremy Hunt's minimum wage decision look interesting to some companies that rely heavily on minimum wage staff next year. When the ONS looks at the figures, they tend to adjust wage growth by CPIH. That's the cost of living, including a housing component. The CPIH is oft criticised because it has a synthetic element for the cost of housing. It's hard, after all, to equate rent with a mortgage. The two situations are not the same, because in a rental you have landlord responsibility. But likewise, tenants may spend on what landlords would consider a luxury, but still the annual move is positive, although it brings it right down to the 1.3 to 1.4% mark in real terms. 131,000 workdays were lost in October thanks to labour disputes. 60% of that was healthcare and social work. 49,000 people were involved in labour disputes, so that's an average of 2.6 days per disputed worker. That 49,000, incidentally, is the lowest monthly total since June 2022. The number employed plus self-employed is up at 36.8 million as at the end of September 23. 210,000 more people than the previous quarter. So things have moved on in absolute terms, but in relative percentage terms haven't changed much at all. 75.7% of 16 to 65s are employed, 4.2% are unemployed, and 20.9% are economically inactive. That means they're full-time students, long-term sick, or have taken early retirement. Long-term sickness is the one that still stands out. January to March 2020, there were 15,000 more people declaring long-term sickness than at the end of 2019. At the last count, there are now 491,000 more than at the end of 2019, and that's the highest number since then. It would be fairly easy to judge this figure, but it should be self-evident that regardless of opinion versus fact on the pandemic, vaccines versus no vaccines, the disease has led to longer-term issues, and the NHS waitings list situation has not helped, of course. It is another worrying trend upwards that needs reversing, and that won't happen until the waiting list situation has reversed, and has been reversed for some months. Anyway, the overall conclusion around all of the employment data would be right direction, and not at the expense of jobs just yet. Ergo, rates can stay higher for longer, but not as long as might have been thought, since the 8% wage growth was expected to drop to 7.7%. Not 7.2, a fairly big miss to the downside. Those who bought the 5-year gilt at a 4.04% yield on Tuesday this week will have been feeling very good by the time it got to Thursday and caved into around the 3.5% mark. That's a pretty amazing 2-day return for a bond. The gilts and swaps move heavily in a property investor's favour this week, shaving 0.5% off the market price of 5-year fixed rate mortgages. So, apologies in advance for shouting, but here's a soapbox moment. If you're doing a mortgage application at the moment and haven't got to offer, make sure your broker is checking for the best rates for you. If you have got to offer, check the fee for switching to the lower rate product if there is one. Right, that feels cathartic. Back to normal chat now. Wednesday was a different day, but with more of the same. I think anyone sensible would agree that wage rises cannot persist at the 7 to 8% level. Otherwise, inflation at that level starts to look extremely likely once workers have had chance to catch up with the recent bout of inflation. Fewer would agree that a 0.3% drop in GDP in just 1 month, that's £7.5 billion, Careless doesn't even cover it, is good news, but it did take further pressure off the bond markets and took Tuesday's 4% 5-year yield down to 3.75. What took it to 3.55 overnight was the Federal Reserve Chairman meeting, where Chairman Jerome Powell decided to preserve his and the Fed's credibility by not trotting out the same stronger for longer rhetoric. The dot plot, where the Fed's committee members forecast where they think rates will be in a year's time, is a full 0.5% lower as a median than it was at their last meeting. The Fed wave impacts the UK markets, and indeed I predicted after Wednesday, but before the Fed meeting, that no MPC members on the Bank of England would vote for a rate rise. 4 voted for one in September, 3 voted for a rise in October, and I was spectacularly wrong. The 3 hawks stayed hawkish and voted for a rise to 5.5%. They were defeated by the other 6 who voted to hold. I actually thought the most dovish, Swati Dhingra, might vote for a cut, but no. The bankers judged it isn't time to even consider ending the lockdown just yet. Or the hawks haven't anyway. With all the figures still up where they are, and no big expectation of a lower CPI before the end of the year's figures, next week November's figures will be out, this shouldn't really be a surprise. They have resisted the knee-jerk reaction as central bankers should. The bond market was as surprised, or as wrong as I was, as the 5-year yield jumped 10 basis points back upwards, as none of the hawks were swayed. It does make sense though, since all of the relevant inflation figures are still so far above target or equilibrium in the UK. The GDP forecast had been an uninspiring 0%, so the miss of 0.3%, especially when you consider that the prediction had been higher for inflation, and the GDP figure is always stated in real terms with inflation baked in, really was quite a miss to the downside. GDP normally roars in Q4, but looks like it will be around break even now for Q4, although Q1 is currently expected to grow. Following the PMIs, the Purchasing Managers' Indices, a contraction in services like we've just seen wasn't unexpected, but the number is above 50 now again on the PMIs, so that's likely to have been a temporary wobble. Too early to say, but this doesn't look like a recession, just more sludge or treacle evidence, as per my preferred analogies of this year. We have to track back to inflation at this point. Team transitory, as some call them, after tails between legs for what feels like a couple of years now, are back, suggesting that they called it. Those who have followed the tapestry closely will know this is utter hogwash. As I joked many months back, everything inflation is transitory, but if it takes 4 years, does that still count? This is also, particularly in the UK, particularly early. Here is the latest Sunak chat. Our priority going forward is to control spending and welfare so that we can cut taxes, or so he told The Spectator this week. Let me circle back around. Inflation's still over 4%. Wage rises next year at nearly 10% for minimum. Inflation-linked benefits up 6.7% in 2024. Pensions up 8.5%. A tax cut, a further inflationary measure, with the stable door still not bolted back on. Anyone else think this is risky? This is a bit like if the lockdown had ended in mid-April 2020. Daily case numbers had started to come down, and there was an argument for it, but it absolutely didn't happen, of course. Some will say that the government was too cautious, and again, in spite of your own position or opinion, one thing we could agree, I'm sure, is that the government was best at educated guessing, and that was the best case scenario. At worst, they didn't have a clue what and when should take measures. For example, eat out to help out, a really minor policy of Sunak's, but the one that has become the most defining as his popularity has waned. I think Team Transitory should still be packing their t-shirts back in their respective boxes, and we should see what happens next year. I wouldn't be surprised at all if next year's CPI hovers between 3.5% and 4% average for the year, which, in case everyone has forgotten, is still well over and perhaps double the government-directed 2% target. Sunak's current pledge is a bit like my secret to weight loss. Overeat in the first place, and then start overeating a bit less, and praise yourself for doing so well. The Conservative proposition is supposed to be don't get fat in the first place, and that's been an epic fail. If you didn't see, Sunak's approval rating hit -49 this week, a joint low with Boris's worst print. Labour are in their pomp, although I think there will be some feel-good factor come April next year, and as I said in the budget analysis a few weeks back, that's what Hunt is punting on. So what else should we note from the macro figures? Industrial production and manufacturing had incredibly disappointing Octobers, both nearly 1% lower than forecasted, and both negative growth. This meant that their year-on-year progress was under 1% on each, and that contributed to the surprise GDP number. The RICS house price balance was also released, and strange to say, the -43 result was a good one. It was much better than the forecast, but for those who have watched the Halifax and Nationwide closely will not be so surprised. This also would have been compiled before the news of this week and lower interest rates. Cue a price war on the high street for mortgages shortly, and rates under 4% will start to appear very soon in the loss leader / grow the business section of the owner-occupier mortgage market. We also had the UK PMI flashes for December, and they told a story of two halves. Manufacturing was well under consensus at 46.4. Remember, 50 is not growing or shrinking, under 50 is shrinking, and over 50 is growing. The consensus was 47.5, so it's a fair miss to the downside. This is the 10th month in a row under 50, and consensus was a change in direction back towards 50 rather than further away, which is where 46.4 sits. Services, however, and remember services inflation represents 47% of the CPI figure, went from a consensus forecast of 51, which would have been a tiny improvement on November's number of 50.9, snapped right back up to 52.7. This is a pretty huge upside miss, but the real moral of the story is that the major engine of our economy on the production side is doing just fine. This is the polar opposite of the GDP figures that have been released this week, but these are flash estimates for December PMI, not reporting on what already happened for October, which is what the GDP figures were. It shows just how quickly things can change. Services PMI had 3 months in a row ending in October under 50, and what came to pass was a contraction in GDP for October and a 3-month flatline in growth on the back of this. But this flash real-time situation looks to ensure positive economic growth for December and pushes the time of the next recession back ever further. Bond market yields immediately flashed upwards on the back of this. The 5-year moved 6 basis points up, but then dropped again significantly, so that this week the opening yield was 3.97% and the closing yield was 3.58%, nearly 0.4% off. A very, very welcome respite for property investors. The market is really betting heavily that a cut is coming soon and is ignoring what the Bank of England is saying, but also what it is doing. At this time, I still feel there's a stronger for longer situation in the next few months, 6 months, at least for base rate, and yields don't look like they can go much lower given that where we're at today. So, a veritable macro feast with some wide-ranging consequences, and it seems fair to suggest that this period of well-priced housing that I've identified some months back, supported by the data, might not last that long. However, let's not get overexcited. I think a fair template for Joe Public first-time buyer next year looks like this. Q1, start the year, been wanting to buy, got a deposit together alongside Bank of Mum and Dad. Can't resist waiting for a bit though, or shopping around to get a bargain. Q2, perhaps find somewhere, depending on what rates are doing and how positive the papers are, but then election announced. Oh, let's wait. Q3, election, take cover. Q4, let's see what Labour do and push the decision into 2025. You could very easily see that a not too dissimilar mindset for a slow-moving investor or retail investor might be the case, although still waiting for the crash, which absolutely looks off, but let's face it, was never really on, as discussed. Inflation has done the damage. H1 next year looks fantastic for acquisition, but I'd get on with it. It might not last. I'm still utterly mesmerised by how hard it is for even particularly experienced commentators to understand inflation. It really is an incredible phenomenon. I write a piece in a well-respected industry periodical each month, and this month my article was critiqued to death about how I'd got it wrong. The chief issue was that the critique was completely wrong and poorly researched, from a really experienced writer from the same periodical that produces work of an incredibly high standard and has made some fantastic calls, particularly around the time of the pandemic when many had lost their heads. People have just forgotten or never understood inflation in the first place. The hard yards have been done here and it isn't yet back in its box. Time to predict an up market for 2024 on the back of this week, and I'm upgrading my forecast to 2 to 6% upwards for the property market in the UK for 2024, but most likely flat in real terms after inflation adjustment. There may be some London drag here, so you might be better to consider that to be a provincial forecast rather than a UK-wide one, as my expertise is not within the London property market. One more piece of analysis for this week. Zoopla released the rental market report for 2024, which was a little more bearish on rent rises than my recent efforts. However, I wouldn't be overly surprised if their 5% rental increase forecast played out. Again, there's a London drag effect here, and I think provinces could be closer to 7%, with London nearer 2% or similar. Zoopla also mentions 2% upwards in London, with the prime reason being affordability. Zoopla data says new lets are up 9.7% year on year, nearly bang on where inflation was 12 months ago. New rental demand is 11% down year on year, but 33% above the 5-year average. Like many post-COVID related market moves, the peak has gone and the trend is going the right way for a functioning market to return, at the moment. There are 20% more homes to rent than 12 months ago, but 18% fewer than the 5-year average. The flow of new supply is unchanged year on year, but 6% lower than the 5-year average. Scotland rents are mentioned, up even more in the past 12 months than the previous 12, but that's likely the timing of the introduction of the rent cap. Richard at Zoopla is keen to point out how counterproductive rent caps can be, and all the evidence worldwide is that he's correct to do so. Richard was also misquoted recently, and upon the release of the report this was turned into some kind of immigration clickbait piece. To settle that once and for all, he mentions 4 reasons for strong rental demand in the past few years. Number 1, the reopening of the economy and the lifting of travel restrictions. Number 2, the strong labour market. Number 3, higher mortgage rates making renting cheaper than buying in some areas and relatively cheaper in all areas. Number 4, record levels of immigration, particularly overseas students, who of course stayed out of the UK during the pandemic as there was concern that UK restrictions were not stringent enough. That's my own emphasis. That's an explanation, and a good one in my view, of what's happened, and not the forecast. The trend is slowing one way or another. Those are all one-off or at least exacerbated factors that are unlikely to repeat themselves anytime soon. 10% of London rental listings are reduced. 7% of the rest of the UK have seen a reduction. The average London household is spending 40.4% of their income on rent versus a nationwide figure of 28.4%. This report comes out quarterly and is well worth paying attention to and seems to hold some pretty good macro predictions. But, of course, you will need to take a view on your own investment areas in order to forecast accurately. The Zoopla prediction is 5 to 8% rent growth ex-London, and I think 7% is a good stab. I do disagree with their forecast that the housing market is going to drop next year, as I've already alluded to, but we can't agree everywhere, otherwise this wouldn't be a useful piece of analysis. So, well done for getting to the end as always. One more nudge for the Propenomix Advent Calendar, with a release each day, one 60-second explainer and one longer form, but under 10 minutes still. Subscribers are very, very welcome. So please go to the channel or to the website propenomix.com and follow on one of the podcast platforms. Thanks for supporting me spreading the word. More subscribers will lead to more and better content. And I'm only going to say this twice more this year. Keep calm and carry on.